Today we are starting with the third chapter of secretarial practice, that is incorporation of a company. We will be talking about the different types of businesses in a subject of organization of commerce. The types of businesses are sole proprietorship, partnership firm and joint stock company. Sole proprietorship and partnership firm are ideal when the business is of a very small scale, but for a large business, joint stock company is preferred. This is because sole proprietorship and partnership firm, the owners have limited expertise and also limited capital. In a company, large sum of money can be raised through shareholders and a wide range of experience is available through the directors. Registration of sole proprietorship and partnership firm is optional, and even in situations where it is preferred to register the firm, the process is very simple. However, for a company, the incorporation procedure is very lengthy, complicated, and expensive. First, let us see the meaning of a company. Company has been defined as a legal person or legal entity under the British common law. Legal entity means that it is a person separate from its member. As per the definition of company, Companies Act 2013 defines a company as a company incorporated under the Companies Act 2013 or any previous company law. Before Companies Act 2013, we had Companies Act 1956, and before that we were following the British law. Characteristics of a company. First, company is an independent corporate existence. This is one of the main features of a company. The company is separate from its members. So unlike sole proprietorship, where you can say that the liability of the firm is the liability of the owner. However, in the company, because the company is a separate corporate existence, the company has its own liabilities and assets which are separate from the liability and assets of its members. Second, limited liability of the members of the company. In sole proprietorship and partnership firm, the owner and the partners have unlimited liability. That is, if the firm is unable to repay its liability, then the partners or the sole proprietor will have to repay the liability from their personal assets. However, in a company, because a company is a separate legal person and it has its own assets and liability, the members are not the owners of the company's assets and its debt. So, the members liability is limited only up to the amount of share taken by them. No member can be required to contribute more than the nominal value of share held by them. For example, if I am a shareholder of a company and I hold only shares of rupees 10,000, but till the date of winding up I have paid 5,000 rupees to the company, then if the company is liquidated or it is winding up, then the court can order me to pay the remaining 5,000. Suppose the company has a liability of say 1 crore rupees, I will not be liable to pay 1 crore, I will only be liable to pay 5,000 rupees, which is the value of my shares. Third is perpetual existence. Company is not a natural person. However, it has been given the status of a legal person. However, because it is not a natural person, it cannot die. And because it is separate from its member, so the death of the members will not result into the extinction of the company. Fourth is separate property. Company has its own liability and asset. The company owns these liabilities and these assets in its own name. It will enjoy the assets, it can dispose the asset, it can sell its own property in its own name, and no shareholder can have a claim over the property of the company. Just like you are not liable for the liabilities for the creditors and loans taken by the company, similarly the shareholders do not have a right on its asset also. Fifth is transferability of shares. Subject to the terms and condition which has been given in the articles of association, the shares of the company can be freely transferred from one person to another. So usually in a public company, the shares are freely transferred, but for a private limited company, there are some restrictions on transferability of shares. Sixth, because the company is in the capacity of a legal person, so it can initiate its own proceedings in its own name. The company can be sued for any breach of contract or delay of services, etc. And the company can sue others for breach of trust also. The company can be sued and it can also sue others. Seventh is professional management. Professional managers are more attracted for working with a company rather than working with a sole proprietorship or partnership firm. This is because of the size of the company and because it has a perpetual existence and does not depend on the life of the owners. Also, the company can afford professional managers to look after various aspects of business like production, sales, accounting, etc. Eighth, finances. So, a registered company will receive share capital or equity capital from its shareholders. Initially, at the time of incorporation, they will receive the share capital from their promoters, and then after incorporation, it can raise share capital from other members also. The company can raise capital or finances in the form of shares or debentures. Each member, whether a shareholder or debenture holder, will contribute the nominal value plus any premium which has been decided for each share. In sole proprietorship, the capital is brought in the forms of owner's fund and through loan. In partnership firms, the finances is brought in the form of partners' capital and loans. While in a company, the main source of finances are shares and debentures. Now let us see the procedure for the incorporation of a company. The procedure is divided into two parts. First, preliminary stage, and second, incorporation stage. Now there is no clear-cut demarcation between the end of first stage and the beginning of the second stage. There may be overlapping in some of the steps. For example, in the first stage we have arrangement of finance. So you can say that in the first step the promoter have approached a bank and seen whether they are eligible for finances. The bank may have assured them that yes, you are eligible, but you will need to provide certain documents like memorandum, articles, list of director, etc. Now the preparation of memorandum, article, etc. is in the second stage. So in this stage, that is arrangement of finance, even though it is part of the first stage, but because you are requiring documents from the second stage, so it will continue even after completing the second stage. So there is no clear-cut demarcation and there will always be overlapping in both the stages. Preliminary stage. In the preliminary stage, we are basically investigating whether it is possible to form a company. So the work done here is intangible in nature. This includes planning and developing the idea of your product, surveying whether your product is useful or not and customers are willing to purchase or not. Then you will be determining the resources which are required and undertake the negotiations for acquiring those resources. In the second stage, that is the incorporation stage, the legal work related to forming of company is performed, like preparation of various documents and filing of those documents with the registrar of company. Now let us see the steps in the first stage. The preliminary stage is also called the promotion stage. It begins with the conception of idea, primary investigation, extensive investigation, analyzing the requirement of resources and capital, etc. This includes 5 steps. First, idea for the promotion. One person or a group of persons may have an idea about a particular product. The idea can be considered as the seed of a business. This idea should then be transferred into a concrete form by developing all the methodologies which can be used to implement this idea. For example, when the idea for an online taxi service was born, the first step had been to develop all the little features of the services. For example, in Uber, the promoters may have decided in the idea stage itself that how the app will be created, how it will use the GPS services, how they can partner with the drivers, and the methodology to start a business without actually owning any vehicles. However, in this stage, the entire concept is in a very raw form and it is not backed with any concrete data. Primary investigation. The economic viability of the idea is checked in this stage. By economic viability, we mean the total expenditure expected to be incurred and the income estimated to be generated has to be calculated. This is done with the help of experts. Needless to say, if the income is more than an expenditure, then it will be a profitable venture. Only then the idea will be implemented. Extensive investigation. In this stage, the government policy, laws and regulation, availability of ancillary service, availability of raw material, etc. is checked. This will help you to understand if the idea is feasible and what are the hardships or what are the problems which you will be facing in implementing the idea and during the operation of the company. For example, if your product creates a lot of pollution, then the government policy regarding pollution will have to be considered. For example, in the case of online taxi services also, the government rules regarding commercial vehicles, the need for background check of drivers, the privacy law for customer data, etc. will have to be considered in this stage. This will give a clear picture of all the hardships and all the decision making which the promoters have to undertake. Next is mobilizing the resources. Now, if after the primary and extensive investigation, the promoters think that the company will be profitable and the company will be feasible, then they will start making arrangement for acquiring the required resources. The resources may be in the form of land, machinery, manpower, software, etc. To acquire these resources, first the promoters will have to identify the suppliers, undertake necessary correspondence with them, negotiate the prices, and then finally enter into various agreements and contract and complete all the written formalities. Next is arrangement of finance. The resources required for your idea will definitely not be free. All the resources and all the expenses will have to be financed, and for this you will have to find various sources of capital. The promoter will have to calculate the total fund required and then find out how much fund can be acquired from which source. The promoter may have their own funds, or they may take a loan from friends and relatives, or they may take a loan from banks. Also, depending on the type of business, government will also be giving loans and subsidies. Promoters can decide on availing government loans also if that option is available. After completing all this, we will reach the incorporation stage. Incorporation stage is where the actual process of formation of a company is conducted. The certificate of incorporation of the company is received at the end of the stage. Now, a promoter can decide whether he wants to create a private limited company or a public limited company. In any case, he will have to submit certain documents like memorandum of association, articles of association, consent of directors, etc. Memorandum of association. This is the basic document of the company. It has 6 main clauses. The name clause, which mentions the name of the company, registered address clause, which has the registered address, objects clause, defines the scope of activities of the company. The liability clause mentions the liabilities of the member is limited. The capital clause describes the amount of authorized capital, subscribed capital, etc. Subscription clause contains the name of the people who are already a part of the company. Memorandum of association defines the relationship between the company and the third party. It states the business of the company. Articles of association. This is primarily used for internal management. This states the rules and regulation for the management of the company. It states the company's policies and methods which are used to attain its objectives mentioned in the memorandum. List of directors. At the time of incorporation of a company, a list of all the directors along with their name, address, age, occupation, nationality, etc. have to be submitted to the registrar of the company. There should be at least one woman director as per the latest government guidelines. Written consent and affidavit of each director. Each director has to sign a consent letter. In this letter, he has to state that he is willingly accepting the responsibility to work as a director. Moreover, all the subscribers and the directors have to state in an affidavit that they are not convicted of any offense, they are not found guilty of any fraud, and also that the information provided is accurate. Declaration. A declaration has to be signed by the person named in the articles of association of the company. They may be a director, manager, or secretary. The declaration has to be prepared in the prescribed form. It should be signed by either an advocate, a cost accountant, or a company secretary. Disclosure of interest in other forms of company. The director, subscriber, manager, or secretary have to mention whether they have association with any other company. Example, if one person is a director in multiple companies, then he has to submit the name of all the other companies in which he is acting as a director. Certificate of incorporation. All the documents have to be submitted to the registrar of company, that is the ROC, along with the prescribed registration fees. Registrar will verify all the documents, and if he finds that the documents are satisfactory, then he will register the company. He will enter the name of the company in the register of companies. After entering the name in the register of companies, the registrar will issue a certificate of incorporation. In the certificate of incorporation, it will also be mentioned a corporate identity number or CIN. The life of the company begins on the date mentioned on the certificate of incorporation. The company is required to preserve the original document and all the information submitted to the ROC till the liquidation of the company. So this is basically a lifetime document. In most of the companies, companies, to preserve this document, they will usually frame it. So if you go to some offices, you may find many framed certificate which has been displayed on the wall. These certificates will include the certificate of incorporation, the certificate of GST number, etc. These are important documents, so the company will frame it and display it for the information of its stakeholders. So with this we complete third chapter. If you found this video useful, then please like and share with your friends, and also subscribe to be updated about our next videos.